Chapter 13, Current Liabilities and Contingencies. What is a liability? Well, the FASB defines liabilities as probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. Let's see. Current event creates a future obligation, would be to me a little simpler. Okay, what is a current liability? Are obligations whose liquidation is reasonably expected to require use of existing resources properly classified as current assets, or the creation of other current liabilities. So let's take a look at some examples of current liabilities. So the first thing we're going to look at is warranty, and we're going to use the expense warranty approach. And in this example, Danny Companies sold 10,000 flashlights during 2016, $500 each. These are very special flashlights. And during 2016, Danny spent $15,000 servicing the 2-year warranties that accompany the flashlights. All applicable transactions are on a cash basis. So now let's take a look at what this means. So again, we sold all these flashlights. In addition, we are estimating that it could cost us, based on our history, $40,000 for the 2-year warranty. And this is not, the warranty is an integral part of the sale. We're not selling them separately. So we're going to go cash, which would be 10,000 units times $500, and book sales revenue. Then we're going to book the actual warranty expenditures incurred, which was $15,000. And then we're going to set up the liability for the balance of the warranty, which would be the $40,000 minus the $15,000 we've spent, giving us $25,000, and the offset would be warranty liability. Now that means any other warranty that is incurred associated with this sale would go against the warranty liability account. Okay, now in 2016, this is a same information but different circumstances, and in this example we have a sales warranty contract that is not an integral part of the sale, but they are sold separately and can be sold separately with a sales value of $50,000 as included as part of the $500 that we paid. And we're estimating that the total cost of these services is $40,000. So now we're going to show how we would journalize the revenue based on this. The cash would be the same, but the sales revenue would be reduced by the $50,000 because we're going to earn that $50,000 over 2 years. And that would become unearned warranty revenue. The next thing we would do is book the actual warranty costs. We would go warranty expense and cash, but then we would book the revenue associated with those costs, which would be unearned warranty revenue. We take it out of that account, and the way we'd come up with it is we would take the $15,000 divided by $40,000 to give us a percentage of how much we've spent of our estimate times the whole $50,000, which is the revenue we set aside for that, to book take it out of unearned revenue and book it as warranty revenue. Now we have another example, and in this example, we purchase goods for $70,000 and they are subject to a cash discount. If paid within, we get 2%. 2% if we pay within 10 days, but we have to pay the balance in 30. And our purchases and accounts payable are recorded at the net method. And we didn't pay it until February 26th, so we missed the discount period. So the day of the purchase, we're going to book the inventory at net, which means we're going to back out the 2%. Then when we actually pay it, which is after the discount period, accounts payable will be reduced by the $68,600. Purchase discount lost would be set up, which is an expense account, and then the cash. Okay, our next example is we bought a truck for $50,000 from from General Motors Company, paying $4,000 in cash and signing a 1-year 12% note for the balance of the purchase price. We're going to assume 10 years, no salvage value, straight line. So at the date of purchase, this interest is going to be accruing over time, and we have a notes payable of $46,000. Now, what's going to happen at the end of the year is we're going to have to book our depreciation and book our interest payable. On May 1st, the corporation borrowed $83,000 from Chicago Bank by sending a $92,000 zero interest-bearing note due 1 year from May 1st. So this has what we call implied interest. So in this case, we're in essence paying the interest up front. So the cash is going to be $83,000. The difference between the 92 and the 83 is going to be discount on note. And we're going to prorate that as interest expense over the life of the note. And we set up a notes payable of $92,000. At the end of the year, we will expense $6,000 and reduce our discount on note. Now, the next liability that we can have is we declare a cash dividend, and we then pay it. So the first thing we do is take it out of retained earnings and set up a dividend payable. And then on the date of payment, we're going to pay the dividend and reduce our cash. The date of declaration, we would do, again, you set up the liability on the date of declaration, and we pay it on the payment date. Now, current liabilities, what can happen sometimes is that we may be able to recategorize our short-term obligations. And the way we're able to do this is by going through this process which says, are you planning to refinance it? So, if we have a short-term obligation or a long-term obligation that's due now, but we intend to refinance, if it's yes, then we have to prove or demonstrate an ability to refinance, which means we should have already talked to whoever we're going to refinance it or set in motion our ability to refinance. If that's yes, then we have to have actual refinancing after balance sheet date but before issue date, or have a financing agreement that's non-cancelable with a capable lender. If we can do that, we can exclude the short-term obligations from current liabilities and reclassify as long-term debt. So this is how we're able to do that. And as you know, why would we want to do that? Well, it would help our current ratio and how they measure our liquidity. So here is an example. In this example, on December 31st, Danny had a short-term debt of $7 million in the form of notes payable to the bank due on 2018. So this would appear as part of our current liabilities. Danny entered into a refinance agreement with the bank that allows his company to borrow up to 60% of its gross accounts receivable. They are expected to range in value from a low of $6 million to a high of $8 million. The interest cost of maturing short-term debt is 15%. The new agreement calls for a fluctuating rate of 1% above prime, with the new notes due on 2022, which would make them long-term. So how should this appear on the balance sheet? Well, let's take a look at the rules. If you have a range, and in this case it would be, we take each one times 60%, we have a low of 3.6 million to a high of 4.8 million. Under GAAP, we are required to use the low estimate. So based on this, it is expected that of the 7 million short-term notes, we are expecting that 3.6 million would be replaced with long-term debt and therefore could be classified as long-term debt on the balance sheet. So this is the way it would look. Notes payable would appear as $3.4 million, showing 3.6 as reclassified, and under non-current, we would see notes payable expected to refinance in 2018 of 3.6. So that's how we would do that. The last thing we're going to talk about is premiums and coupons. Companies should charge the cost of premiums and coupons to the expense in the period of the sale that benefits from the plan. Warranties and coupons are loss contingencies that satisfy the conditions necessary to record a liability. So let's take a look at a problem. To stimulate the sale of its Mad breakfast cereal, my company places one coupon in each box. 5 coupons are redeemable for a premium consisting of a children's hand puppet. In 2017, the company purchased 40,000 puppets at $1.50 each and sells 480,000 boxes of Mad at $3.75 a box. From its experience with other similar premium offers, the company estimates that 40% of the coupons issued will be mailed back for redemption. During 2017, 115,000 coupons are presented for redemption. What do we do? Well, first, we're going to book the purchase of the puppets, which is inventory of premiums, which would be 40,000 times $1.50, and cash. And then we're going to book the sale of our cereal, which is 480 boxes times $3.75. Then we're going to determine the redemption expense. We had 115 coupons divided by 5 coupons per puppet times $1.50, the cost per puppet, which means that we would have had premium expense of $34,500, and we would credit inventory. Now, what else do we have to record? Well, we have to set up the liability for the remaining coupons outstanding. So, the liability, we know that we had 1 coupon per unit sold. We're estimating that 40% of those will be redeemed, which means that's 192,000. They have redeemed 115,000. So potential redemptions are 15,400 puppets. So our estimated liability, take that times $1.50, is going to be 23,100. So our journal entry at year end would be premium expense 23,100, premium liability 23,100. That completes examples of current liabilities for Chapter 13.